Welcome back. You're watching Indian Open right here on Bloomberg Quint Live. Can breathe a sigh of relief, at least for now, looking at the Asian markets. 0.25% higher on the SGX Nifty. The rest of Asia, too, holding steady, about 0.5% plus for Nikkei 225. China and Hong Kong, too, trading with some amount of gains. But yesterday's collapse and the break of 11,200 on the downside can mar this sentiment a bit.
I don't think anybody believes that we'll sustain these levels. So. I don't either.
Sustain these levels on the downside? We'll see a rally?
Upside, yeah, we'll have a 0.25% uptake. That doesn't mean anything really. I think the US markets were cautious ahead of the Fed decision and ahead of the trade talk outcome. Doubt Asia will do anything different. What do you think?
Yeah, and in terms of, still waiting for some earnings to come out, some cues from the monetary policy, whether or not that happens. 700 points in a month is a lot for the index. I mean, we're down, and even worse for the broader markets. So we're down almost 10% on the mid-cap index for this month. And that, there's no sign of a reversal thereabouts. But one solace, and with most derivative as analysts talking about the fact that, the market is light. So, and we've already seen a sell-off. We came into the month of August light. So I don't know how much more there is to sell from these levels.
Well, let's try and take a look at the derivative space. Navneet is standing by with the FNO setup for the morning on a day when the BOB copies come out very late as well. Navneet, how's it looking?
I'm still not sure if the BOB copy is uploaded on the exchange's website.
Sajid just told me it's finally come.
It is finally come, thank God. So I'm not going to highlight on the open interest change figures, but still, what happened yesterday, I think today all eyes will be on the 200-day moving average for Nifty. Markets were weak for this fresh start of the week as well, but we defended, by the way, the 11,150 mark in yesterday's trade, and the 200-day moving average is at 11,150. So that's one number you should keep an eye on the downside today. For Bank Nifty, which did receive a lot of support coming in from ICICI Bank, remember that's a heavy weight on both Nifty and Bank Nifty, that did outperform, but no major gains were seen for Bank Nifty. But yes, one index which stood out in a falling market like yesterday's was the volatility, which spiked up once again. So India Volatility Index was up about 7.5% around the levels of 13. Options data is indicating a range of about 11,150 to 11,350. So this is the distribution. Maximum open interest on the call side has shifted from 11,400 to 300. That's telling you the base is also moving lower with that. And on the put side, the maximum open interest is at the 11,200. If you go by the premium on the 11,200 put and the 11,300 call strike, that's giving you a range of about 11,150 on the downside, which also happens to be around the 200-day moving average, and 11,350 on the upside. Very quickly, what happened yesterday, there was a lot of call writing which came back into the system, as you can see on the screen. 500, 400, 300, and as well as the 200 call strike became very active, and lower level put strikes were seeing open interest addition. Finally, just the stock futures, which were in focus, reacting positively to the numbers. A lot of cash-based buying was also seen, by the way, for ICICI Bank. On future side, long positions reacting negatively to the numbers was Havel, short position seen here. Despite of clarification coming from the group, no respite coming in, fresh shots seen for Indiabulls Housing Finance. And Apollo Tyres comes out with the earnings tomorrow. It was at 52-week low on yesterday's trade. Fresh shorting was seen ahead of the numbers for this stock. Back to you guys.
All right, Navneet, thanks very much for that. So that's the futures and options setup that we have at this point. Neeraj, I was doing a hit for Bloomberg and post that there was a chartist who spoke about the Nifty, and he said that while you may actually see short bursts, he doesn't question the Nifty going down to about 10,600 also.
Yeah, well, I think yesterday a couple of other people have said that as well. Now it's anybody's guess really what can happen, but from the looks of things, today's first word was an example of the sentiment. We had mid-cap IT, and that's in doldrums. The Bloomberg Quint Auto Dealer Survey suggests that July will be a bad month. Yeah. Shouldn't come as a surprise, but it's a bad month. Then the CEO salaries seem to suggest that they've had to take a pay cut, and which is the variable pay cut, which would mean that the consumption and the staple space is also under a bit of a cloud. And the commentary from almost all companies seems to suggest that all is certainly not well. It may not be terrible, but it's not certainly not well. And all of these things should tell us a story or two, right? There is something wrong with the economy. I mean, we can all go out and talk about what the FPI surcharge has done, but as we discussed yesterday, that seems to be the last straw on the camel's back. The real problem seems to be what's happening to the economy. And if the economy is slowing off, there's no way that corporate India can come out and give shining numbers, really. So this whole talk of the earnings growth revival happening, Devina, in FY20,
You know, it's a bit too delayed because the conversations I remember started off by the fag end of FY19 itself, and then you move on to Q1, that doesn't deliver, and then your overall yearly projections start to get questioned. So now you probably look at your entire year earnings getting revised downwards now, because you know, as you incrementally move forward, more and more pressure to perform starts getting pushed to the upcoming quarters, and whether or not.
And I don't think it's easy to deliver there, right?
Yeah. So you have cyclically weak quarters for most of them, and in good quarters, if companies are not being able to perform, then in a weak quarter, I dare say what they'll do.
Yeah. So the earnings is going off, and the P multiple will also get reduced if indeed the economic growth slows down. We already on optical numbers down from 19 times to about 16.5, 17.
Yeah.
I dare say if the earnings revision, EPS revision gets revised downwards, then the PE might still not look as cheap. And that's the worry, really.
You know, an interesting point here, obviously, in a slow market, when the growth is not there, you know, how do you approach, you know, return ratios? Is that something that you focus on? Companies which have managed to tackle and outshine the last 5 years average in terms of return ratios, and the only pocket that comes out is IT. I mean, you have PSUs which have done really well on their return ratios, Coal India, ONGC, you know, you have a few outliers there, but no one's really touching PSUs right now because of the kind of supply overhang you have from the CPSC ETFs. But IT as a pocket, and I'm talking about the larger IT names, they
probably stand out.
They stand out in terms of their return ratios holding steady, and you know, they're a safer haven bet. So.
Well, let's wait and watch if they indeed hold out or no. Well, you know what? These discussions can go on. I think it's also important to talk about what will happen to the here and now and the key stocks in focus today. So let me take across to our research team to try and figure out what is it that we should focus on today. A clutch of numbers that have come out, some stocks in news, and of course some other things to watch out for based on reports. Darshan, Mishika, Yatin, as well as Agam join in for all of that. Good morning to all of you. Darshan, let's start off with you. Dr. Reddy's and disappointment, I reckon.
Yeah, it's been a while since they came out with numbers after market hours, so it was disappointing. Revenues were below estimates, given the fact that US didn't do all that well. A couple of the other markets did well, but the PSAI as well as a proprietary business didn't do well. If you're looking at the EBITDA, that came in below estimates. Profits were much higher, given the fact that the other income was much higher. Now, basically, if you're looking at some of the important factors that you need to watch out for, the big disappointment, according to me, was the gross margins that saw a contraction both on a yearly basis as well as a quarterly basis. North America didn't do all that well. It was decent, but India managed to do well. The other emerging markets managed to do well. PSAI proprietary didn't do well. A couple of the commentary that came in terms of the launches that were there, that indicated there could be some bit of delays. R&D costs were down this time around, leading to a jump as far as EBITDA is concerned. The management commentary wasn't all that great. They indicated there could be some pressure on some of the launches. Some of the brokerages have actually maintained a cautious notes on Dr. Reddy.
Well, cautious notes on Dr. Reddy's, and it'll probably reflect in the stock there. Let's wait and watch if it does. But that was not the only set of earnings that came out. Some others too. Mishika, what stood out? Good morning.
Good morning. So I'll take you through the key earnings. First one's DLF. They came in with a weak set of numbers. The revenues are down 12%, EBITDA is down 22%, and net profits up 2.4 times on exceptional gains and higher other income. Then we have Bharat Electronics. Their revenues remain flat. EBITDA was up 11%. Margins stand at 16.7% versus 14.9%. And net profits up 12% due to higher other income. Then we have IFB Agro Industries. Their revenues were down 20%, net profits down 74%, EBITDA is down 73%, and the spirit segment revenue went up 22%. Also, their marine segment revenue was down 42%. Last on the list is Reliance AMC. Earnings ahead will be aided by lower costs and pass-through fee cuts. Also, the AMC has been losing share due to losses amongst corporate and HNI clients.
Okay, thanks a lot for that, Mishika. So do watch out for some of these numbers as well. And then a couple of stocks that will come out with their numbers. Need to talk about both of those. Hero MotoCorp and Tech Mahindra. Tech will, I'm sure, come out post-market hours. Hero, I reckon, would do the same. What's anticipated there, Yatin?
So Neeraj, like other auto companies, Hero MotoCorp will be no different. In fact, we are expecting a double-digit fall in their overall EBITDA as well as profits. Now, if you look at the revenues for Hero MotoCorp, remember this time we had a 12.5% kind of a decline in the overall volumes, and probably probably that is the reason why we are looking at a revenue decline of 7%, which will come on a year-on-year basis. Of course, realization growth of 5% year-on-year will be supporting overall revenue growth. As far as EBITDA is concerned, we are expecting a double-digit fall here, largely due to the fact that the volumes are low. Not only that, we have the selling prices which are under pressure for the two-wheeler industry, and hence because of lower margins, this time we're expecting profits also to decline in double digits by 14% to a level of 782 crores. EBITDA margins also seen falling by nearly 150 basis points roundabout to a level of 14.1%. Now, the key issue to watch out for will be the management commentary. Most of the auto companies we spoke to, or the auto companies spoke to, the analysts on the conference call have said the fact that the demand is slowing and the environment in the short term is quite uncertain. Hero MotoCorp being the leader in the two-wheeler space, we need to watch out for the management commentary, especially with respect to the demand in the rural markets and the visibility ahead of the festive season.
Okay, we will watch out for all of these. Thanks a lot for that, Yatin. What about Tech Mahindra? Agam, what's anticipated?
Well, it's going to be a tough quarter, Neeraj. Not unlike what we've seen in case of the peers. Certainly a big margin contraction. But starting off with the revenues, we're expecting a decline of around 1.3% in dollar revenues. Margins are expected to contract substantially to 13.3% against 15.4%. Consequently, profits could decline by 12.5% sequentially. Now, we are keeping an eye on delay in deal ramp-ups. That's the reason why we are seeing the weakness in your overall top line. 2.5% decline in the telecom business. It is the biggest business for the company, and we are still seeing a very slow trickle down of the 5G allocations as far as Europe is concerned. We'll be watching out for demand outlook and a lot of commentary, keeping an eye on something like your 5G deals. And of course, Comviva is going to be a seasonally weak quarter, so that could also add further pressure to not only the top line but also margins. On the whole, we're expecting a weak quarter for Tech Mahindra.
Okay, so weakness across. Thanks a lot for that, all of you. Mayuresh Joshi, fund manager at Angel, joins us right now on the show with his thoughts. Mayuresh, good having you. Thanks so much for joining. We'll talk about some of the numbers that will come out later on in a bit. Let's talk about something that came out. Dr. Reddy's. After a while, numbers released post-market hours, but that don't do anything. Operationally, looked a very weak quarter. What did you make of it?
It was a mixed bag. Morning, Neeraj. So again, I think if you look at the gross margins, when you probably look at the overall performance specifically from the top line front, I think it was an okay set of numbers. Now again, I think the management commentary that probably came through, and again a couple of their drugs, Nuvaling and Copexon, I think they've got postponed to FY21. So I think the expectations from these key blockbuster drugs to contribute significantly, specifically in terms of the niche segment itself, I think that might have some amount of delay, and that will clearly get reflected in terms of the earnings outlook that most of the analysts maintain. The second element obviously is also the resolutions of a couple of their plants, and even if these resolutions come through, I think the generic approvals along with the R&D spends, which can be around $250-300 million, 9.5% of the overall top line, will also keep EBITDA margins in check. So I think an okay set of numbers. I think we've got a neutral rating onto the stock.
Okay, let's talk about the ones that report today. Anything that you're anticipating to be a standout from Axis Bank, Hero MotoCorp and Tech Mahindra?
No, so I was hearing Yatin and Argam. So clearly, I think the stress in terms of the auto volumes are going to get reflected, and they are getting reflected in terms of auto numbers at large. So I think he's absolutely right. I think the management commentary is something that one really needs to pay attention to. What largely happens for Hero MotoCorp, for example, I think the rural component is a significant take for both their volumes as well as the expectations in terms of the future pipeline as well. And in both these regards, how Rainfall probably pans out over the next few weeks is going to be extremely critical on how these parameters play out. The second element obviously is also going to be the elevated costs. So what you've probably seen in terms of ABS, CBS rises, with BS6 rises, with faltering demand, the companies do not have the pricing power to push through the cost entirely. So some absorption probably happens at their end, which means that the entire pass through to the bottom line with weak EBITDA margins probably still stays. With festive season coming around, there is some hope that the pipeline in terms of inventory built up should start happening over the next few weeks, and there will be some pickup. But what after the festive season? I think is there going to be again a slump that we're probably expected to see if conditions do not improve? So I think management commentary is going to do the trick. For Tech Mahindra, as Argham mentioned, I think it's going to be a very, very tough quarter for these guys. I think Comviva's seasonality will almost shave off 100 odd bips from the EBIT margins. You've obviously got the wage hikes as well, which will shave off another 100 bips, cross-currency headwinds. And again, I think the entire pyramid that they've probably got at this point of time, I think they are a little bit behind in terms of investments on the digital side. So those investments still need to continue. What happens in terms of the transition costs for the huge deal wins? And the enterprise business outlook has also got revised in the quarter gone by to 6 to 8%. So it's going to be a tough quarter for Tech Mahindra as well.
All right, lots more to talk to you about, Mayuresh, but time now to bring in our technical experts. Hedren Mendonca, Senior Technical Analyst at IIFL, he's joining us on the show. Along with him, Amit Harjekar, Director at Index Genius Investment Advisors, is also here with us. Starting off first with your index calls, we broke below 11,200 yesterday, Hedren. Does it look like there could be a possibility of a slight bit of a bounce from these lows?
Yeah, hi, good morning. Definitely, Nifty currently is actually, poised around very important, crucial support areas. So the first one is the long-term 200-day moving average, which is coming around the 11,160 mark. Whereas if you notice the May 2019 lows are around 11,150 levels. Now, if you go to the weekly charts as well, this support is actually coinciding with the rising trendline support area on the weekly charts for the Nifty as well. So definitely right now, we may see another, 50 or 100 points of further sell-off from here on. But I think the risk reward is definitely tilting towards the bulls currently. Keeping just 100 point stop loss from here on, one can actually consider going long. But only for the bravehearts, because there seems to be no respite, no matter which kind of support areas are seen around the Nifty. But I think this dual support that we are talking about should hold on, and we could see some kind of meaningful bounce back from here.
Would you agree, Amit?
Well, I have a contrarian view to the Hedren. Now, if you see on the index perspective, on a weekly basis, Nifty has confirmed a 3 black crows formation, which indicates that there is a more downtrend which is likely to open up after we have seen a close below 11,150. Our first target on the Nifty was around 11,150. We think that has got achieved. For next leg of decline, we are suggesting our clients to opening up short positions once the Nifty futures breaches 11,180 mark. We could be heading for the levels of below 10,900 thereafter. Now structurally, if you see, despite the decline in India VIX or volatility, we are seeing this market is facing selling pressure, and this selling pressure is basically taking place mainly due to because market is falling on its own weight. So we believe there is a more potential downside from current levels. We are not suggesting any clients to play for a pullback rally, because underlying structure is extremely weak. So the strategy would be again wait for a break below 11,180 on the future side, again open fresh short positions on this market. We think this market has the potential for again a double digit decline from current levels. So probably it's a shorting market. Apart from that, in this week, last week, we had also seen Nifty Private Bank Index forming a lower low, which means it breached the 15th May low, and the Nifty Private Bank Index is clearly indicating a downside of at least 10% in the near term. So again, that is the area where one can open up short positions on an aggressive basis. So we have both a sell view both on Bank Nifty as well as Nifty in the near term.
Okay, let's get down to stocks then. Amit, what are you going to be recommending this morning in terms of specific stocks? And I also want to go back to one of your earlier recommendations, which was, I think, going short on Infosys. How does one either close that strategy or play it now?
Well, in fact, even last week we had suggested some put option in Infosys. Now we believe Infosys now becomes the around top 5 holdings of most of the mutual funds. But if you see the entire structure of Infosys in last 3 months, it is taking a shape of an rising wedge. Now this rising wedge is an indication that a lot of overbought, the prices are trading into an extremely overbought zone, and a correction from these levels is likely to trigger at least a sell-off of at least 7 to 8% in the near term. So on a very short-term basis, the upthrust line for Infosys rising wedge is placed at 830. So we are suggesting to keep a stop loss of that on the futures, and on the short-term basis, we are expecting a target somewhere close to around 740 to 730. So overall, our perspective is there is a good breakdown which was also visible in Nifty Service Sector Index, which is mainly driven by both financial as well as IT. We have already seen a good amount of decline in financial stocks. I think now it is the time for IT stocks to participate in the sell-off. Our second pick would be IndianOpen Bank. Here too, we had told that IndianOpen Bank was oscillating into a bearish triangle since last 6 months, and we see this is a very high conviction call from a positional perspective. Here the risk reward ratio is so favorable because the triangle breakdown is projecting your target of below 1000 levels. So what we are suggesting is, from a positional basis, you should buy 1380 in IndianOpen Bank put option, which is trading at around 28 to 30 rupees. You place a stop loss of 9 rupees and play for a target of 70. We are expecting a target of below 1200 in IndianOpen Bank, which should be achieved in next 10 to 12 trading sessions.
Okay. What about you, Hedren? Your stock ideas?
Yeah, so I have a sell and a buy both. So the stock that we are slightly bearish on is a Tata Chemical. So it is a clear case of breach of important support levels and also an extension of the lower top, lower bottom structure. The stock was actually consolidating for the past 2 weeks, and it has finally broken down towards the lower end of its overall trading band. So I think one can consider going short on a Tata Chemical August futures. We are expecting a target of 566. Keeping a stop loss at 581. Now, it was very difficult to find out, these positive setups because there were more negatives than positives. But, ICICI Lombard is one stock that is really showing good strength. In fact, when markets were reversing badly, being trounced, ICICI Lombard was a stock that was actually, moving strength to strength. This is a stock that's showing pretty immense, resilience. We are seeing 50-day moving average being held on to very well. Going forward, I think one can consider going long on an ICICI Lombard for a target of 1196, keeping a stop loss at 1163.
Okay. Stay on, gentlemen. We'll come back to you with more stocks, but on to our special segment, Bloomberg Edge, where Yash Upadhyay tells us about a pattern that the Bloomberg terminal has thrown up on a particular stock today. Yash, what's the stock?
Morning, Devina. So we're looking at HDFC Life on the charts, and there's a sell signal coming in on the back of the MACD indicator. Now, as you know, the MACD is a trend following momentum indicator, and it basically shows you the relationship between the two moving averages. How do you interpret it? You go long when the MACD line crosses above the signal line from below, and you go short when it crosses below the signal line from above. Now, coming back to the price chart, on the daily time frame, what has happened is that with yesterday's fall of nearly 3%, the MACD line, which is the blue line in the lower panel, that has given a negative crossover. So it's crossed below the signal line, which is the white line, to give that negative crossover. And we've seen that level happening at a very high mark of close to 15 on the MACD. Now, not just that, we're cheating here a bit because on Friday's Hot Money Technical, we did talk about HDFC Life, and I want to bring that chart up again as well. On the weekly time frame, what we had seen is that around the mark of 500, it has been facing a bit of a resistance. In fact, this is where we are preempting this pattern, but it is forming a cup and handle sort of a formation. So it came up to the levels of 500, it went down all the way to 350, and then it came all the way up to 500. But over the last few weeks, what we've seen is that we are seeing at higher levels selling coming here. So just a simple explanation, this is the open, this is the close, and this is the high of the candle. Now, every time the stock made newer high at higher levels, we saw bears coming in and pulling the price down again, and that had been happening for the last couple of weeks. And yesterday what we saw is at the neckline, which is at the mark of around 500, we saw a big move on the downside. The RSI 2 on the weekly had crossed above the mark of 70, so it had crossed the overbought zone as well, if you could see, and that was the first time since April 2018 that the RSI 2 had gone above the mark of 70. So at higher levels at around 485, which the stock is quoting right now, you could see more weakness come into HDFC Life.
How well has this worked in the past, Yash, for HDFC Life?
So Neeraj, 5 out of the last 7 times that the MACD has given a negative crossover, the stock on an average over the next 1 month period has gone on to fall close to around 8%.
Okay, Yash, thanks so much for putting that into perspective. Remember, this is the stronger bastion of the market, and if that were to correct 7-8%, then you know that people are now starting to get out of even the strongest of names. Frankly, insurance companies have been stronger than banks in this last few days. The results were very strong too. If this were to correct 7-8%, then it tells you a story about the kind of selling. Heavily owned by foreign institutional investors is HDFC Life. Let's wait and watch what happens to this stock. Mayuresh, fundamentally, and keeping in mind that FIs are consistently fleeing, so a bit of a techno-funda call of sorts, because you would take into account the mood of the market too, and the valuations. Would HDFC Life, even if it's a buy, be a buy at lower levels? And currently, would you avoid it completely?
No, so you're absolutely right. I think if one really stacks up valuations at this point of time, I think HDFC Life is one of the most expensive stocks within the life insurance space. But again, I think to be fair to the stock itself, I think the numbers have also done the talking for them. So if you probably look at the value of new business, if you look at the VNB margins that they're posting, they're consistently higher than all of their peers. The second element in terms of the underpenetration of the insurance market itself, I think all the players probably are having a huge advantage over the next 5 to 10 years. But again, I think the product mix that a lot of these players are now adopting, they're all going towards the protection plans, which secures their margins to a great deal. And again, buckets in terms of their persistency ratios, I think they have held up pretty well. So there are no issues with numbers per se. I think if you probably look at the embedded value at this point of time and the price to embedded value, yes, on that parameter itself, I think it's very, very expensive at this point of time. So again, I think in terms of the ownership that you're probably talking about and the expectations that if money is expected to come off the table or profit booking expected, I think these stocks have actually made tons of money. So I think some shedding off can actually happen, but nothing wrong fundamentally with any of the insurance stocks, at least at this point of time.
All right. That is, as Neeraj highlighted, one area where you have seen some sense of some strength coming about in a falling market. We've got about 4 minutes left to go for market pre-open. Just want to quickly get in, Hedren, on some of these Indiabulls group stocks after the sell-off yesterday. Is there a bigger downside open for at least the likes of an Indiabulls Housing?
Yeah, absolutely. The stock is, really looking weak, and after yesterday's fall, it is also confirmed, breakdown on the weekly charts. 4 weeks back, we saw that huge, clamp down on the stock, but we saw a good recovery since then. But, post that, resumption of selling pressure is pretty evident on the weekly charts, and I think it really opens up, a huge downside for Indiabulls Housing Finance, more specifically. I think on the downside, if the 500 levels, which was touched in the previous big clamp down on the stock, if that important level is broken, I think it further dampens the overall structure for Indiabulls. So it is advised to not go long on Indiabulls Housing Finance.
That is completely given. But Mayuresh, that same question, would you, if you have Indiabulls Housing Finance in your portfolio, for that matter even Indiabulls Real Estate in your portfolio, yes, there has been significant price damage, but would you still advise getting out of them?
No, so there are too many news flows, Neeraj, at this point of time, and they just keep on coming week after week. So I think if somebody is holding on, I think you probably need to monitor these news flow at this point of time. But from a fresh investment perspective, I think you should actually let all these news flows settle down. I don't know when and where, but again, I think it's better advice to just wait and watch on the sidelines, not do anything with them at this point of time.
Okay, the other one is Vedanta. The stock was down 5% yesterday, was down 4% the day before that. No amount of management clarification really did anything for the stock. Even post results, the stock saw a big cut coming in. In the last 1 month, I think the stock's dropped about 11.5%. Amit, what would you do with Vedanta now?
We have a positive view on Vedanta from a positional perspective. We think the stock is already into a bottoming out zone between 148 to 155, and we have a target of around 200 plus from a 3 months perspective. So in case there is a major dip, we think this is a good stock to accumulate from a positional perspective. from a trading perspective, I don't think so you can apply any meaningful stop loss at these levels. It's more of a trade where the best trade would be try to accumulate around 148, 150 zone, hold it for 3 months, and then we can expect a target of beyond 200.
Okay, that's Vedanta for you. 1.5 minutes left to go. On Tech Mahindra, would you take a trade today, Hedren, ahead of numbers?
I mean, the stock has actually done nothing in the past 3 to 4 trading sessions. Any kind of anticipation that we could see or we could try and observe ahead of the results in terms of price movement, it has been completely muted. So this consolidation is actually indicating that we are seeing some kind of consolidation ahead of the results. So we'll have to see if these major support points or the resistance points are broken on the upside. So levels to watch out for Tech Mahindra on the upside is around 660. That is the important resistance. If that is broken, we could see a good major upside on a Tech Mahindra. On the downside, the lower end of the trading band is around the 635 levels. So this is the trading band in the past 4 to 5 sessions, which has to be broken for any kind of directional move. And results would well give that trigger to the stock.
Okay, let's wait and watch if the results do give what kind of further trigger. The expectations are, of course, that the results would be wobbly in the session. So, save for Axis, the other two are not expected to come out with great numbers on the Nifty. But today, a lot of non-Nifty names will be the important ones, the likes of Piramal and Dish TV, etc. But, 18 seconds left for the markets to kickstart trade, and Asia is painting a green picture.
Yeah, 0.25% held on by the SGX Nifty, 24 points higher. But it's not about the start, it's about how you end the day. But today's session can anticipate a slightly better performance at the pre-open on your screen. Nifty 50 opens 0.25% higher. Sensex is about 0.5% higher this morning. Starting off with your gainers, initial upticks coming into some of the names like Bharti Airtel, 3% higher. Dr. Reddy is up about 1.9% post numbers. Wipro is up 1.3% odd. Eicher Motors is showing you an unnatural uptick of about 6% odd. Reliance Industries at 12.22. HDFC Bank, there's some amount of recovery there. Remember, HDFC twins, have been dragging over the last few days, and some bounce coming back into today's pre-open session for HDFC Bank. GAIL, L&T are up 0.75% each. Axis Bank ahead of numbers is up. TCS has moved up about 0.5% odd, and Tata Motors to just 0.25% higher. Tata Motors now at about 137. Amongst the losers, Power Grid loses out. Indiabulls Housing continues to witness pressure, and NTPC, HCL Tech, Hindalco are some of the other losers. Not as many losers as gainers, but still, you've got the rupee now at 68.71. That's some strength that has come into the currency, but very marginal.
Okay. Just 3 or 4 names from the broader end of the spectrum. Some key losers in yesterday's session were the likes of Vodafone Idea, Tata Motors DVR, and Dish TV ahead of the results. All of these cracked. Wonder what they are doing in the session today. As a start, has just been okay for them. Den Network seems like starting off positively, but really that could be just about a flash trade. I don't know if Den Networks has that uptick of a 17% possible or no. So let's leave that aside. ADAG might react slightly positively today if the market start off well. And unfortunately, because of the founder going missing, Vijay Siddharth, the founder going missing, the founder of Cafe Coffee Day, that stock starts off 20% lower. So do keep that at the back of your mind. Bloomberg News has of course reported that Vijay Siddharth has gone missing, and that is having its impact on the stock. Unfortunate event that's showing in the way the stock is reacting in the session today. Not too many gainers, some losers. That's the nature of the day. The bond yields should come up. Yesterday come off a bit. In the run-up to the policy, we might see the yields correcting a bit. When the finance minister tells you that lower rates would help, you would probably factor that in when you're a bond trader. So let's wait and watch if that were to happen or no. Okay, Suntech Realty showing an offbeat move. I don't think that will happen either. So these 3 or 4 names that you really need to monitor when it comes to trade in the session today. Some stocks which came out with numbers, we've spoken about the large caps. A couple of mid-cap names, Mayuresh. If you track them fundamentally, what did you make of these results? DLF or Reliance AMC?
No, so DLF again was a mixed bag. Yes, I think the sales were better as is showing over the past few quarters. But the velocity in terms of new launches, I think that is clearly what is going to define the performance going ahead. The leverage has come down in the balance sheet as well. So that's another positive that you can probably take. But as I mentioned, I think the areas that they function out of, I think the demand-supply dynamics are not warranting both the angles, at least from a near-term perspective, both in terms of sales velocity catching up and realizations improving, which needs to get the necessary leverage or the operating leverage on their balance sheet, improve cash flows and reduce the debt. The second element obviously is also going to be their annuity portfolio. So I think that portfolio has held up pretty well for DLF so far. But what happens going forward, I think, is also going to be extremely critical in terms of commercial launches and the fit outs and the management commentary expected around that. The third element obviously is going to be the overall profile for the sector as a whole. And when you probably look at the entire sector, at least at this point of time, I think the clearance of existing inventory, I think, is also going to be extremely critical for all these developers at this point of time. So I think again a mixed bag in my opinion, Neeraj, from DLF.
Bearish, if Vinati Organics were to dish out another good quarter, is it a stock that you would look to buy? Because it's, of course, a very expensive stock.
No, I don't track that, but since you mentioned that, I think I'll have a look at that.
Okay, yeah, the numbers come out today. So the key numbers that come out today, Vinati Organics, Dish TV, Piramal Enterprises. And I'll be watching out for Heidelberg Cement with the kind of numbers that some of the cement companies have come out. The expectations from Heidelberg would be good, the geographies that it caters to and the pricing in the last quarter. So let's wait and watch what Heidelberg does in the session, as would VIP, of course, but Heidelberg is a really interesting one to monitor in the session. The one that cracked big time yesterday, and wonder if what do the charts suggest out here? Vodafone Idea. Amit Harchekar.
Do you need the charts to tell you anything?
Yeah, but I do need the charts to, because when I look at the price, it looks that all is over. Amit, what do you think of the stock on the charts?
Well, I've stopped tracking it below 9 rupees.
Not surprised. Well, Hedren, by any chance, do you track Vodafone Idea?
Absolutely no. I mean, the stock is in a completely falling zone. It's falling like a knife. There is not much left for it to fall. It would be better not to burn your fingers with such stocks.
This goes back to some of those stocks where suddenly you want to know whether or not they are likely takeover targets at these levels or no. I mean,
I don't know if anybody wants to get into telecom, to be honest, and I don't know if the Aditya Birla Group is on the block because they have put in money at 12 rupees in the rights issue.
Yeah, and aside from the fact that now we've been constantly talking about how there is consolidation in the telecom space, it's down to 3 players now. I mean, yeah, while they have a huge subscriber base, but with that kind of debt on the books, I mean, the viability is just so questionable.
Well, yeah, so, but when you speak to PE experts, everybody say that it still would likely remain a 3-player market, so there's no questioning that. The only question mark is with the kind of service issues that Vodafone is facing, what happens to the subscriber base, because that showed a very deep dent. But, that is a question for another forum. Right now, Mayuresh, since we're talking about the price, a lot of people bought into Vodafone when the promoters subscribed to the rights issue, thinking that if promoter is putting in money, I'll put in there. From there, it's nearly halved. A lot of people might be enticed to buy it. Would you advise against it, or would you believe the risk reward is in somebody's favor?
No, so again, time and again, I think on our discussions, Neeraj, I've vehemently pointed out, I think you should stay away from the telecom sector. And largely, again, I think the issues that you pointed out, they're absolutely right, at least at this point of time. I think look at the service issues that Vodafone is facing. I think even my phone, I think the call drops every minute that I probably try to patch on to somebody. Apart from that, I think they've got balance sheet issues. So I think the net debt to EBITDA at 20 odd times. You've got the new try order, which has probably come through in terms of what Idea and Bharti have to pay out to Jio in terms of the interconnectivity charges of almost 3,000 odd crores. Top that up with spectrum charges, you're probably looking at a transition to the 4G, and they're one of the weakest links as far as the 4G base is concerned compared to the other two players. Bharti at least has the cushion of the African operations. They've also got the broadband operations, which might be a little bit under the canner again as Jio Fiber probably rolls out, and what kind of impact does that have on prices and margins. But clearly, I think the financial performance is nothing home to write about. So I think the price right now looks very, very mouth-watering. I think, yes, the promoters did put in money in terms of the rights issue. But again, I think there are a whole host of issues in terms of balance sheet repair, which are not going to whisk away in a short period of time.
This has an eerie similarity to Dish TV also. When we spoke about promoters putting money at about 100 rupees, the stock's at about 36 rupees. So it really, I mean, while we talk about, promoters are putting money, but market has got its own course to chart.
Yeah, it does, and it's showing in the way both of these stocks have done issues, and really showing in the way these companies have performed. Well, as the pre-open rates settle down, what is doing well is ICICI Bank yet again, another percent or nearly a percent higher. Axis Bank ahead of the numbers, some bit of pullback today after the kind of slam dunk that it has seen, and maybe some autos have a half decent day. HDFC Bank too, looking like starting off positively. So those 2 or 3 names are the ones that we should monitor. Actually, very quickly, Hedren, before we tell our viewers all that they need to know, since you sound more bullish on the markets, would you take a long call on ICICI Bank?
Yes, in fact, after the results, the stock has actually really managed to maintain, the gains that we saw in yesterday's trade. I think from here on, things would get much, much better for ICICI Bank. Yesterday's huge volume, along with, almost a 3% gain. I think there is still more legs to go, higher from here on for an ICICI Bank. And, it seems to be the only, one that is actually holding on to something. So I think ICICI Bank clearly stands out, and I think from here on we could see further upside in ICICI Bank.
All right. I remember ICICI Bank at levels of about 350, or that's the time I think a few months ago. There was one conviction call that I think Vikas Khimani had a few months ago when he said that if it's one bank that I look at, it'll be ICICI Bank. And then from there, the stock is just has seen that upward bias and the climb thereabouts. This year itself, stocks up about 28%. And it's probably not about the kind of outperformance, but just weathering the storm is something that you want from a stock in such a market.
Yeah, and they've done that admirably so. Okay, minutes away from market open. Let's tell you all that you need to know to stay ahead in trade today. First up, Dr. Reddy's June quarter earnings miss analyst estimates. Subdued sales in North America weigh in on financials.
DLF's revenue fell 12% and margins contracted. On the other hand, earnings were flat for Bharat Electronics, but margins expanded.
Keep your eyes open for Axis Bank's results today, as a low base is likely to help the bank report a stronger bottom line. Recoveries from the watch list will be the key factor to watch.
Tech Mahindra and Hero MotoCorp are the other 2 Nifty companies slated to report their June quarter numbers today.
Lastly, watch out for Piramal Enterprises, PNB Housing Finance, Dish TV, Vinity Organics and VIP Industries as they too come out with their Q1 numbers today.
Okay. Just quickly, Mayuresh, while we're at it, just want to get you in on the specialty chemical space. It was a pocket of interest, but since the collapse in the market, would that still look like a place to be?
Selectively, yes, Devina. And again, I think what the events have transpired specifically in the Chinese markets over the past few months, the blasts which happened in China. And again, I think the expectations that one really has at this point of time with the backward integration facilities that a lot of the good quality specialty chemical players have at their Indian operations, I think that probably helps them stand out. The second element obviously is also that there will be an element of exports because of the US-China trade wars that are probably ensuing at this point of time, that a few of these makers probably have the upper hand. The third element obviously is going to be what kind of chemicals are you into. So I think chemicals is a wide space. So I think the pricing thereof, the demand-supply dynamics thereof are going to be extremely critical. A few of the specialty chemical players have done exceedingly well even on the Indian operations at this point of time, as they embark upon their export initiatives as well, which a few of the players have hinted to. I think they also protect their overall revenue pie and the margin mix itself. So yes, as a space, looks interesting, but I think you have to be very selective in this space again.
Okay. Mayuresh, take a moment to thank you for joining in today and giving us your thoughts. Really appreciate your time.
Thank you so much.
Right. 2 minutes left for the markets to kickstart trade. And before we get in the top call from our experts, just looking at the pack and seeing what has done well and what has not. Incidentally, Vodafone Idea is doing okay in the pre-open session. But yeah, Jet Airways, Spark, and some of the others have come off. Actually, Amit Tharchekar, quick 30-second comment. Sun Pharma Advanced Research. When Sun Pharma's upgrades came in, that stock had a bit of an uptake. A lot of people turned bullish. It's kind of cooling off. Do you think it can cool off more?
Well, the entire consolidation from 15th May onwards for Sun Pharma Advance is taking a shape of rounding saucer, and which means any declines towards 150, 154 becomes a good buying opportunity. The potential target from a 1 month perspective that falls in the zone of 185 to 190. So I think this stock becomes a definitely buy on decline. If anyone wants to keep a stop loss, I would say 128 should be a stop loss on a closing basis.
Okay, time now to get in those top trading ideas from both our technical experts. We're just 1 minute away from market open. Hedren, let's start off with you.
Yeah, I'll go with another sell, and it's a sell on Bharat Electronics. The stock is actually cracked from a rising channel pattern on the weekly charts, and also, yesterday it broke below its long-term 200-day moving average. So one can consider going short on BEL August futures for a target of 89, keeping a stop loss at 93.5.
Amit?
Well, I have 2 sell calls. One would be going short on L&T. Here the stock has now given a triangle breakdown below 1385. We are expecting it to go towards 1280. Stop loss for the fresh short would be at 1420. Second trade would be going short on SBI below 345. Here the rationale is Nifty PSU Bank Index has given a good triangle breakdown after 3 months of consolidation. We are expecting a 10% decline there too. So here the stop loss would be 360, and we are expecting a target close to 310 from a positional perspective in SBI.
Okay, gentlemen, stay on. We'll take in opening thoughts from you, but here's how the markets are starting off today. In the green, 0.25% for the Nifty 50, 26 points, 11,217. The Sensex at 37768, up about 90 odd points, and the Bank Nifty up about 125 odd points, nearly 0.5%, or slightly less than 0.5%, I believe, propelled in part by HDFC and ICICI Bank. Let's wait and watch. The mid cap and the small cap indices starting off flattish, very, very flat for both the mid cap and the small cap index. So the market breadth would be okay on the broader end of the spectrum. On the Nifty 50, I reckon the market bet would be positive, marginally positive at that. Actually, it's almost even Stevens, to be honest. What's doing well? Let's start off with the green first. We have started with the red a number of days now. UPL up 1%, top gainer. ICICI Bank up another percent. Z ahead of the Dish TV results today, up 1%. Mind you, that also is a fray of some deals. Let's wait and watch if that happens. Bajaj Twins, Finserv and Finance up another percent apiece. JSW Steel is up 0.75%. And Yes Bank is up another 0.5%. So those are 4 or 5 names that you need to monitor today. What is not done well on the Nifty? Indiabulls Housing Finance, 2.5%. So that continues to grind lower. 11% downtick yesterday. Another 2% today. The stock price behavior is telling you a story, isn't it? Hero MotoCorp down another percent. There is weakness in ITC, but I don't see too many other auto names in the red. So they might not be gaining big time, but I think they must be somewhere in the green. Maruti's marginally in the green. Can't spot an Eicher in the losers either. So marginally in the green, maybe for Eicher Motors too. There are 2 or 3 names that I would monitor. Okay, very quickly, some other stocks, some stocks on which there were short positions built, some stocks which have corrected or are in focus today. Let's pull up some of those. So firstly, fresh shorts seen in Havells, seen in Apollo Tyres, seen in Indiabulls Housing Finance, as I spoke about, and all 3 start off lower. So the shorts are already in the money. Let's wait and watch what happens there. Apollo Tyres in particular down about a couple of percentage points. What else? A set of stocks in which you would definitely want to monitor them. So one is Dish TV, of course, ahead of the results today. Let's wait and watch what happens here. Tata Motors DV had a slam dunk yesterday. Let's see if it recovers. Vodafone, unfortunately, after that 27% downtake, continues to grind lower. 6.65 now for this stock. It's almost 50% discount to the rights issue price. Deena, what are you spotting?
All right, so let's start off first. Obviously the broader market setup is still weak as compared to the larger, broader indices. We've still got more stocks declining in early morning trade. The index is absolutely flat, no indication out there. But individual stocks, and we'll start off first with the gainers. Bharat Electric is up about 2%. You've got Strides Jashun, that's up about 6.5% at 375. Taking its 7-day tally to about 8% odd. Dish TV does well, you already spoke about that. Sobha does well, that's up about 1.8% odd. Gati has moved up, Dredging Corp has moved up. So some of these PSU names are doing okay for themselves. Alembic Pharma, that stock has moved up about 1.25%. Aurobindo Pharma, too, doing well. So the pharma, mid-cap pharma has a pocket, is holding out. Lupin too is up in trade this morning. National Fertilizers, Den Networks, 1.25% higher for each of these names. Prestige Estates, that's up. BF Utilities is also up about 1% odd. Amongst the losers, that big lower circuit for Cafe Coffee Day. You've got Gen Irrigation, that's down about 6.5% odd. A lot of penny stocks which have lost out, and then you've got the likes of Tata Sponge, which is down 3.5% odd. Orient Cement is down 3%. Remember, Orient and Heidelberg, both of these counters, last 2 days, I think, did well. Post numbers being reported from ACC in Abuja, and now some amount of profit taking, I believe, for Orient Cement, which is down about 3%. Heidelberg reports numbers today, so watch out for that one. Persistent Systems, MRPL, Kansai Nerolac reported numbers yesterday. It did well. The management, spoke about, a slight sluggishness in the industrial paint segment, but the decorative paint segment trying to catch up and cover that gap. But the stock was up yesterday, it's down about 1.5% odd in today's session. But that's what you've got in terms of the market opening setup. No big bang move, neither on the index, probably 1/3%, but the mid-cap index is, very warm.
Yep, it is, and it's looking slightly wobbly. By the way, Indiabulls Housing Finance is no longer the top loser. It is Dr. Reddy's lab, but iBulls Housing Finance too is down about 1%. Just before we thank our technical experts, a quick chat out there. We haven't discussed Grasim at all. It corrected big time in trade yesterday. Hedren Mendonca, quick opening thoughts, maybe a word on Grasim.
Yeah, as I already said that, the risk reward definitely is in favor of going longs currently. As long as we see the Nifty hold above the 11,150 zone, 11,140 zone, the risk reward continues to remain in favor of the bulls. As you've rightly mentioned earlier that, it's not, how we open, but how we close. It has been the story for our markets in the past 1 week, 1.5 weeks. We open on a, flat note and then we sell off. But, if today's trade, if we manage to, hold on to those important, crucial dual support levels we spoke about earlier, I think that would be the first sign of a minor pullback. Secondly, I would like to see Nifty close above the 11,300, 310 crucial resistance zone. That would actually confirm that, a reversal is on the cards. So, 11,310 would be very important for Nifty to break above if we are going to see an extension of the current rally.
Okay. Amit, what about you? Quick opening thoughts?
Well, frankly speaking, we are expecting the magic of 3 black crows to now force Nifty lower towards 10,900. As I said, a fresh level to open short positions would be below 11,180 on the future side. Below that, we are expecting a target of 10,900 straight away.
All right, gentlemen, we'll leave it at that. Thank you so very much for joining us this morning. Hedren, as well as Amit, appreciate it. Bringing in Chakri Lokapriya, the Managing Director at TCG Asset Management. He's joining us right now on the show. Chakri, thanks very much for taking out the time. Everyone's talking about trying to find value in this market. Losing 700 points on the index in a single month, that's not a small amount. Is there value anywhere?
See, there are a number of things happening here. Since the budget, the issues are all local, whether it's higher taxes for FPIs or local.
Well, sure, because the rest of the world is doing fine.
The rest of the world is doing just fine. So against this backdrop, now you have an electric vehicle, for instance, they want it by 2030. So how do you then value an auto company? So you assume that sales go down to 0 by 2030, of course being replaced by electric vehicles. So which means your terminal growth rates, terminal valuations will all tend towards 0. So clearly, of course, they'll be replaced by electric vehicles. So this is the issue. So there are lots of things which are become spokes in the wheels, tightening on across the board on various sectors, which is led to a kind of what should be the fair value of the stock is. Some of it is a question.
Okay. So Chakri, the globe is holding out, India isn't. Post the Fed tomorrow, or maybe in the medium term, listen to a number of global commentaries and they express skepticism or what happened in the Eurozone area. If that were to come off, does it have a larger domino impact on India? And do you therefore reckon that the larger probability is of our markets to drifting lower or sharply going lower from where they are right now?
I think India's problems are its own creation and has less to do with global, because
but what if the globe also starts underperforming?
Because for all the talk about US and China trade deal, US is up 20% year to date, China is up 20-25% year to date, depending on which index you look at, Shenzhen, Shenzhen, etc. Exports numbers are still decently holding up for India. If you look at, still therefore we like the IT sector, we like the pharma sector. So, but that's still a very small component for India Inc. to hold up, Indian economy to hold up. So against that backdrop, I think this whole thing of infra spending by the government, if it indeed takes off, starts executing, that is important for the overall market to hold up.
Just, want to get your sense as to, while everyone's talking about the entire taxation that's scaring the FPIs, could it, also be a factor of them not seeing much incentive to stay in India with regards to earnings performance that they could get at a cheaper valuation in another country?
It's a combination of both, and importantly, taxation is a long-term issue. Of course, in India, they change it every single year, so that's a different story. So against that backdrop, when you're telling an FPI, look, we are going to take away roughly half your returns in the form of taxes, so that leaves the returns, which is far lower than even developed markets or which even other.
In the current scheme of things, is non-existent.
Non-existent. So on a non-existent, so that it makes the case even weaker to invest. On the other hand, second is the other factor, earnings are slowing down. And if you look at the current quarter, there has been, I think the earnings downgrade will be somewhere about 7%. So FY20 will end up being 7% lower. So now you'll probably let mid-teens as at best, assuming things don't get worse.
From 23 to 25%
Indeed,
earlier.
Indeed. So we'll probably, now it's probably about 13 to 15%. So there is both an earnings slowdown as well as a higher taxation, which makes the overall returns less attractive versus other markets. India has underperformed both developed markets and emerging markets over the last 6-7 months.
Okay. Now, Chakri, again, I come back to that context, though, that if indeed, let's work with an assumption that India corrects a bit because of its own doing and goes down to valuations which are optically between 15 and 16 times. And then the world market starts to unravel a bit, because at some point of time, the world markets will unravel. Does India become, because of being amongst the top 3 countries in terms of growth, become a place of safety because valuations are in your favor and there is growth? Or you don't think that because of these taxation issues and policy mismatches, etc., that will happen?
See, 2 or 3 things. If you look at currently the Nifty, is trading at the demonetization level of valuations.
Is it?
Yes, more or less, about 16 times.
Okay.
Because then earnings growth expectations were higher.
Sure.
Now the earnings growth expectations have moved lower. It's also trading similar to the levels of probably about 2010 or 11. Mind you, again, the difference at that point in time, earnings growth was close to single digits. And now it is still well strong into double digits. So then the whole thing hinges on whether indeed you will see an earnings recovery, because right now we're talking earnings downgrades. All managements across the board, whether it's consumer or corporate, are coming and cutting estimates. So that cycle needs to flip around, so which is unlikely to happen for the next couple of quarters. And I guess then you need some amount of policy help you see, look at the auto industry. I mean, the CM and other associations, they coming and saying that, look, we need government intervention to support the industry.
If it doesn't happen, Chakri, a follow-up to that, if it doesn't happen, what's your view on autos now? They've corrected quite significantly, but that doesn't mean anything. Prices can correct 50% and then correct another 50% as well, right? There's nothing to say it doesn't happen to the best of companies. What's your view here? What do you do with the auto pack now?
See, CM has cut, for instance, passenger vehicle sales for next for FY20 from +5 to -4.
Yeah.
That's a 10% swing, right? And so when a company is degrowing according to the industry, so its valuation should be less than what's worth today.
Right.
Then the only question becomes whether you will see a reacceleration. Now, reacceleration can happen only on two fronts. One is, of course, there is a government intervention and they do something about it. And second, they actually push out the EV.
They did something, but on the other side.
On the other side, right? And if you cut the GST on an electric vehicle, a vehicle which is not there, it doesn't help. And
this is like taxing the non-existing profit.
Indeed, absolutely. So on one hand, I think those are the issues. So therefore, the valuations at 18 times, Maruti is not a cheap stock if you look at the growth prospects.
Yeah, and India has been a growth market, hasn't it been? Yeah. I mean, you come to India for growth, not for value. Traditionally, it's been the case.
You pay the premium for growth.
You pay the premium for growth. So yeah, I think Chakri's point is well taken. I mean, maybe at 18 times too, on hindsight, Maruti might look expensive 1 year down the line. We don't know that as yet. Please don't take this as my prophecy, but I'm just saying that it may well happen.
Yeah.
Yes.
The other, obviously, point being, what does one do now when we're talking about the government push, capex spending, infra spending, a whole lot of sectors dependent around that. I'm not just talking about the likes of L&T, but you have cement to look at the other commodities, to look at steel as a sector, which is feeding into the infrastructure space. How does that play out? Because up until now, the spending was pushed back. This year actually has had a lot of wait and watches. Does that culminate into something?
I think one of the easiest things, or rather, which is under the government control, is infrastructure. They're announcing and executing on road projects, etc. The infrastructure is within the government's control, so which then directly benefits all the sectors that you talked about, which is cement, EPC companies, steel companies, etc. So right now, because of elections, etc., and other well-known reasons, the order execution has come down, but it's quite doable for the government to accelerate that. So I think that's where the hope lies in the L&Ts of the world and the cement companies and the other related companies. But overall, if you look at, for instance, you mentioned steel demand is actually, domestic steel demand has weakened. Domestic steel prices have corrected. So against that backdrop, you then need this push. Now, are the valuations demanding for an L&T and EPC and cement companies? No. So from that perspective, that's where the support is for some of the sectors.
Just the valuations?
Just the valuations.
Okay, that's actually not a bad one to be in, L&T for one. And the other one, obviously, is you spoke about the safer haven names of IT and pharma, which obviously are not the big contributors to the overall growth of the economy, but are still pockets where you can seek shelter in.
Indeed.
So how long does that last, that excitement to be probably seeking safer haven investment?
If you look at the US growth, I mean, we're talking about phenomenal numbers in terms of the GDP growth, corporate earnings, etc. And so against that backdrop, BFSI spending is still very strong, which is important for Indian IT companies, and as well as manufacturing, retail are all very strong. 5G is not yet picked up all over the world. And so from that perspective, IT as a sector, therefore, has earnings visibility, and the earnings visibility gives you a certain amount of clarity to the PE that you can give. And the same story holds for pharma, but more selectively, because pharma has individual company FDA issues.
Okay, Chakri, my final question to you really, and that is on what would you do with the mid-sized banks? You look at these companies very, very closely, and this time around we've seen a bank or more meet that growth speed breaker, which has pushed it back by anywhere between 2 quarters to 4 quarters on the earnings front, on the growth front. Now, is it risky, therefore, to go out and bet on the mid-sized banks? Because because of the environment, there might be hiccups which might just push them back, which might be major speed breakers for these small banks, but just be minor hiccup for the larger banks. So therefore, because of the environment, for the time being, avoid the small banks, try and bet on the large banks. Is that a good thesis, or you don't agree?
I think that's a thesis selectively, because if you look at the large banks like ICICI have shown that they're increasing provisioning, which is a very good thing in a slowing down environment. Overall, like SBI cut rates yesterday, which shows that there's ample liquidity in the system. So when there's ample liquidity in the system, it gives a bank more wiggle room, whether it's a large bank or a mid-sized bank. Mid-sized banks have also corrected. I mean, their valuations are undemanding today. They've all done good jobs in cleaning up their book over the last 3, 4, 5 years. So from that perspective, yes, mid-size, some of the mid-size private or maybe even the PSU banks are more longer-term plays because there's more value in them. On the other hand, with the large ones like what you call ICICI or Axis, valuations are still not yet demanding. At the same time, you can see growth out there because clearly the larger ones will continue to take market share versus the mid-sized ones.
Which brings me to an interesting anecdote with regards to the index polarization that we've seen in terms of the weightage of stocks. Top 10 weighted stocks now have been pushed to the upper end of weightages. So every time you see the top 10 stocks garnering about 59% plus weightage, that's the time that you start seeing a slight bit of a dip in those top 10 stocks and the bottom 30 stocks starting to pick up because there's been so much of polarization. Mutual funds have been piling up on only those 10 stocks. So the ownership also increases of those 10 stocks. And then finally you see them starting to come off and the bottom 30 picking up. Do you see that happening now? Do you see that polarization being taken to the peak?
You know, it's a self-fulfilling prophecy because what's happening here is as the weightage of the top 10 stocks also is increasing because, you know, as all the mutual funds and all the market participants gravitate towards those stocks just price movement moves higher. Therefore, the other stocks weight goes down. And therefore, there's a rebalancing upwards more towards the top 10 stocks. It's a technical thing, but as the weight of the top 10 stocks keep increasing, more money has to go towards the top 10 stock. This music will stop at some point. The question is when. But until that point, I think the top 10 will continue to see increased flows.
Well, very, very insightful chat today, Chakri. Thank you so much for taking the time out and being in our studios and talking to us.
Thank you.
Thank you.
Thank you.
That's the view from Chakri Lokapriya. And moving on to one more market opinion, large listed consumer-focused businesses in India have matured and face the risk of wealth erosion if they don't innovate and disrupt, according to venture investor Nikhil Vora. Here's a snippet of his take on disruption, consumption, and some more from the sidelines of the Alpha Ideas 2020 conference. Listen in.
I just feel that India is at the zone where listed businesses are pretty much businesses which have matured and lived the life cycle, and the ability to innovate and disrupt existing businesses is very, very found to be wanting. So I don't see them playing the disruptor role, which is so critical in a market like India where disruption seems to be the apt thing to do. So, and I keep reflecting this, you know, if I look at Fortune 500 and I've talked about this often, I see 90% of them die or become irrelevant over a period of time. I see listed market in India pretty much symbolic of the Fortune 500 companies. They die or they become irrelevant over decadal cycles. So the market behavior that one has seen over the last 3-4 years, it frankly, while it pains all of us, I'm sure, to all our investors also, but it doesn't really surprise me so much. I think this is something which was just about waiting to happen. It's happened faster than what possibly one would envisage, but I don't see that changing drastically. And I'm not saying as market momentum and stuff, but I think businesses slowly will erode unless they change and disrupt. And I don't see the ability to disrupt existing leadership to be of a very high order, or it's in a very, very few spaces. And I see that happening at a galloping space in private companies, private entrepreneurs, first generation entrepreneurs who are really taking this opportunity to disrupt market leaders. So that's the reason why Sixth Sense was formed, that we thought we will invest in disruptors in consumer space. And So what I've said in the Alpha 20 ideas is pretty much what I believe in, that I think existing players, existing listed companies, even if they are leaders, their ability to maintain leadership and sustain value of that leadership is going to be extremely challenging. You will have exceptions, but like I always believe, exceptions don't make the rule.
Yeah, but why is, just wondering, because I'm intrigued by this, why is that? I mean, it may well be that the current set of examples that you're seeing around in the listed space are not doing that, because being listed is not a prerequisite to not being disruptive, right?
Yep.
So at some point of time over the next 2, 3, 4 years, even large listed companies which would have large profit pools as of now because it's banking on an existing set of businesses could probably throw out a niche or two which could be disruptive and change the model?
Yeah, I agree. So like I said, exceptions will be there. But when I look at broader businesses in our country right now, look at banking. Yeah, you have a dominant leader in, let's say, a State Bank of India or a HDFC Bank and so on. But the disruption in financial services is not being led by an SBI and an HDFC, right? It's being led by players outside that context. It's being led by, let's say, a new age consumer finance company like a Bajaj, which has evolved in the last 7-8 years, or a Paytm in some form, and a lot of other fintech companies as we look at it. So disruption in financial services, which should have ideally been led by existing leaders, it's not being done by them. Disruption in consumer businesses, which is very close to my heart, is not being led by the levers of the world or ITCs of the world and the Colgates of the world. It's being led by new age businesses who are doing it in niche, in spaces which they are very comfortable doing. But the more they get comfortable in a particular niche, their ability to scale becomes more apparent. So a lever is not disrupting space, or a ITC is not doing it. You see newer players. So Aviva is doing it in some form. You start to see it in Bira, for instance. And I'm being biased because we own stakes in these companies. Bira is doing it in alcoholic liquor space. Yes. And so Parag is doing it in milk and so on. These are all relatively new age businesses which have evolved. And you'll see many develop. My fear, and this is true in a lot of work, look at print, which is very close to you guys, right? Print and media. I've looked at that space. Not a single print player, and we're talking about large existing players like the Bennett Group, Times guys. Look at HT, for example, Jagran. So the top 3-4 players, not a single player, and maybe I'm being critical of them. So be it. I think not a single player has actually innovated and disrupted how print should be in India for the next 10 years. How Indian consumers will consume print over the next 10 years. They are not going to consume print by reading a newspaper anymore, or that's becoming slightly irrelevant over a period of time. You've seen players evolve in that category. So in shorts has evolved, whereas the leaders have not really done the development. Look at auto, very, very, very interesting example. In a world where the top 3 auto companies in the world actually lose money, the GMs and the Fords and the Chryslers of the world, you have it in India, where the largest players, the Tatas, Mahindras, Maruti, for instance, have done practically zero innovation or zero disruption in the category. Autos is a space which is getting disrupted almost completely with the advent of the Olas and the Ubers of the world. And ironically, I remember Mr. Mahindra at some stage talking about the fact that they will have consumption issues because the sharing capability of Ola and Uber will increase, and thereby people will not have cell phone cars. I fail to understand why a forward-looking corporate like Mahindra's could not have created an Ola in India.
But we've seen those examples before as well. I mean, for example, none of the hotel chains thought of creating an Airbnb. Aren't these essentially, I mean, I'm just wondering, aren't these essentially tech companies which have come out and consumer tech companies which have managed to do this? Your complaint is legitimate, maybe that the original product owners could also have thought of being consumer tech, but they have not thought of doing so. But
precisely my point. Hotels, beautiful example of a business like the Taj and the Oberoi's and all chains that we look at, right? They've been static players. They've been brilliant at the product. So nothing taking away from all the guys who've done it, whatever they've done. But the fact is they've been ineffective for the consumer 10 years forward. What have they done to ensure that the customer base that they've established in a Taj or Oberoi's moves along with them? They can move along with them only when Taj sets up another Taj, right?
Sure, okay.
They've lost the customer because in India, you have a situation where there is just so much of balance sheet which has been invested in our country. So all of us somewhere have invested balance sheet capital, created asset. No one was setting the P&L of that balance sheet, right? OYO proved that they could create a model. I'm not talking whether OYO succeeded financially. They've done it in terms of capital raise and so on. But I think they've shown the way of what one could do with balance sheet capital invested in our country. I fail to understand why a Taj, or look close again to one of our portfolio companies, Saffron Stays. They've created this premium holiday home play, which is about literally all the assets created by us who bought the next holiday home and so on. There's no reason why Taj should not be doing that. There's no reason why Mahindra Holiday should not be doing it, right? They have members, they have demand. They fail to create supply, which is the worst thing that can happen in a business. Businesses struggle when they don't have demand. Here, ironically, we have all leaders who are struggling because they could not cope with the relevant supply that the consumer was wanting. They have demand. A banking channel has demand. That's why you're talking about unbanked bank and microfinance and tertiary banking and so on. Automobiles have it. Ola and Uber are proving that. They've not gone to where the consumer is going. Even if it means pure tech or significantly tech enabled, there's no reason why leaders could not do that. And you had startups doing that role. So I think the failure in India as of now is about leaders' inability to take the risk of disrupting their own existing businesses and the fear of disrupting their own business and thereby losing what they are at today, to the obvious risk of actually losing the entire business tomorrow. I think that is very, very ominous to them. And I frankly hope, but I have not too much of belief. While I hope of that, I don't have too much of belief that leaders have the ability to change. It's very, very tough. It requires someone to take that ownership. Professionals very rarely will take that ownership. It has to be the entrepreneur, the promoter who has to take that call. And I hope some of them do.
Okay, so let's drive the conversation closer to where your heart is, and which is consumption. Now, two things. When I look at the set of portfolio companies that you've invested in, they are, if anything, but traditional. They are not traditional at all, right? And when I look at the listed space, arguably with the fall in the valuations of some of the financials as well, the only pocket, save for IT, which has been meandering at the same levels, the only pocket where valuations have still held out despite trends starting to come off is consumers. Now, two things. How do you see this dichotomy or this things shape up in light of the fact that you probably don't even believe that the existing consumer plays in India will probably have the same success in creating value as the new age businesses would have, which are the kind of businesses that you are investing in?
Yeah.
At 6 cents.
Yeah, so, my sense of this is that when one says that values have got disrupted, India has never, very rarely, let me say that, has been a value market. India has been a growth market, right?
Okay.
So I think all of us somewhere get trapped into believing that value is what we want to protect and we are good at capturing the value. I think our failure is when we don't capture growth along with that value. And to me, Indian market is symbolic of that in some form, that we think that because markets have collapsed, the values are becoming very enticing. I think that's not really the case, right? It's about saying whether the values are falling, whether the growth are still sustaining. We don't have that happening right now. So if I look at consumers, or frankly any business for that matter, but consumers because we do that at 6 cents, is that, in the market, in listed market also, while everything around us has possibly collapsed by at least 50%, if not more, over the last 3 years, we've invested in 2 listed companies in the same period. We've made 7 times and 10 times the money in 2 listed companies in the same period that one's looking at. I'm not saying we did something earth-shattering about it, but the fact is that there are pockets of businesses and sponsors which we think are doing or playing the disruption which the leaders are not able to do, and they can't participate in that disruption. So for instance, we invested in contracting. That was our big theme about why consumer contracting will become very large. We believe that the leaders will find it a struggle to grow beyond where they are. They'll not grow meaningfully. If they don't grow meaningfully, then they have to let go of what is tertiary to them because they need to grow and keep sustaining their brands and so on. So they'll protect the 60% ROI business, which is brands, and let go of manufacturing, which is a 16-17% ROI business. That's the great opportunity that we thought will happen. And we've seen that we invested in a company called Hindustan Foods, which has now become possibly the largest consumer contracting company in India in 3 years. We invested in JHS. We've sold that at 7 times, but we invested in JHS, which is the largest oral care manufacturing company in India. They control 15% of oral care. So I think it was about opportunity in businesses, whereas the larger players in the businesses, we believe will get disrupted or not changing too much for their own good. We thought there's still opportunity. So I think that is what investors, all of us, need to really look at, which is while there can be mayhem in listed space, or there has been mayhem in listed space, but there is opportunity which is getting created because of mayhem. And at every point in time, right, someone's loss is someone's gain. I think we need to somewhere, as investors, because it's all our capital or our investors' capital, and we need to be fiduciarily protecting that as much as possible, or do it with the best intent possible. I think there's an opportunity in crisis. There is crisis in listed market. But there is opportunity in listed, maybe rare, maybe few, but there's significant opportunity in guys who are disrupting the listed guys, which is in private.
And you can catch this entire conversation on our website, bloombergquint.com. We take a break. On the other side of the break, we decode the June quarter earnings for PVR with CFO Nitin Sood.